All right, so this is QID 1567325. We are doing our, not every week, but about every other week, we do a live stream overtime Zoom session where folks can bring questions like Phillips and we go over. If it's a Kaplan question, you just bring the QID and I can bring up the question backstage like I did this one. If it's an explication request for some other vendor, well, then you need to cut and paste it or send it to me or put it on your screen. All right, so let's go over this question. To protect against possible inflation, your client purchases tips with a 2.5% coupon. First thing I would give you a test taker's heads up on is the coupon doesn't change. The adjustment is not made to the coupon. That's a thing that doesn't change. Over the next years, the annual inflation rate is 6%. The principal value of each of the tips will be closest to. So, in the math, I like to do dead reckoning. What I mean by dead reckoning is it compounds, but I could basically say this is going to be 6%. They're going to adjust the principal every 6 months, the Treasury, what they owe you by the Consumer Price Index. And it says that I've had this for 6 years. So if I take the 6 years times the 6% inflation rate, which means they're going to increase this thing 3% every 6 months, and I times that, I get, and this is I call dead reckoning. I'm not going to be right on, but I'm going to be damn close. So 60 times 6 years. And when I do that, Philip, I get 360. So now I'm going to go to B, but I say, well, if we're compounding, it's going to be something a little north of that. And the only number that's north of 1360 is choice A. Now, if you don't want to do what I just did, which is called dead reckoning, Philip, then you would simply take this and times it by 103%, because that's what that is, right? 3% is half of the six. And you times it 12 times because we get paid semi-annually. And that would have put you spot on to choice A. I
I
like
like that.
the dead reckoning method better, where I just say, okay, if they're going to, the US Treasury says we're going to adjust the principal, Philip, we owe you, adjust it by the CPI, and CPI 6, I can say, okay, well, that's going to be 1,030, and then 103% of that, a little over 1,060, 103. But I can just say, if it wasn't compounding, it would be 1,360. And if it's compounding, it's got to be something more than that. That's how I would answer this question.
All right, thanks, Dean.
You bet. All right, let's go back to the chat. By the way, let me hit the recording. I will put that into our channel, but remember, there's already 5 or 6 of those that you can see me do. So let me just go back and find out where I can kill the recording. Huh. Oh, well, I guess we'll just record the whole damn thing. Micah or Mika. I think you told me it's Micah, I think, from last time. Is it Micah?
It's Micah.
There you go. Joint accounts, very testable on all exams. I'm always surprised people forget this is going to be testable on every exam. You've got to be able to contrast joint tenants with rights or survivorship with tenants in common all exams. I have a lecture, Micah, I call I See Dead People. There's all kinds of questions on all these exams about dead people. What happens when somebody dies? Whether it's power of attorney ceasing, whether it's, cancel open orders, contact legal department, all kinds of them. So with joint tenants with rights or survivorship, test question, the decedent's share goes to the surviving party. And both parties can act in the account, both parties own that account. Whereas in tenants in common test question, there's a fractional ownership, 70-30, 80-20, 50-50, and the decedent's share goes to their estate or beneficiary. I don't think there's any FINRA or NASA exam in which you will not be tested on that distinction. So, I don't know what happens to people. It's like they forget customer accounts when they get to the 65 or they get to the 66 and it's still there. I mean, I just had a guy today. I'm surprised how many customer account questions there were. I don't know what to tell you. By the way, the tests are written based on what they think are critical functions to being an investment professional. we're not attorneys, but boy, one of the biggest mistakes you can make is registering the account in a way that will jam somebody up at some future date, right? As I just told you, for example, if it should have been joint tenants with rights of survivorship, and you put tenants in common, and then somebody dies, that money's frozen. And that's probably the time when somebody would need access to those funds. One more thing, it's not a joint account, but the other thing is make sure you understand transfer on death, which works best with individual accounts, and that avoids probate. Bridget, this is a live stream overtime session. This is not the venue for options. I mean, that is a huge, huge thing. I have hundreds of hours on options. Within that category of options, do you have something you would like some help on?
No, just I don't know if you have any just maybe your top couple tips on
Well, I'll
options.
tell you what, Bridget, I am Thursday doing a basic options class. And that is $35. And there's 4 sequences. They're available replay for free. But I have an introduction to option contracts that you can find on the channel, about an hour or so. Then I have basic options you can find on the channel. I have a third video on stock plus options, and then I have advanced option strategies. Those are 4 videos. Those videos are about 5-6 hours. So obviously, we can't do this in 45 minutes.
Right.
Or
Okay.
so, but if you had a particular question, I guess I could give you what I always tell people. If you only remember one thing about options, call up, put down. Call up, put down. If you know what that means, call up is a great memory aid device for 2 things. Intrinsic value, call up. If the market price is up from the strike price, the contract has intrinsic value.
Mm-hmm.
Call up. Today, Apple, Bridget, is 228. So a 225 call is in the money, has intrinsic value. Why? Because the market price of Apple, 228, is up from the strike price of 225. Now, the reason intrinsic value is important is because on the test, they'd like to do time clock questions. They like to say, your customer goes long, 1 Apple September 225 call at 9 when Apple's at 228. Who cares? But then they like to go several weeks later. They like these time clock questions. And they say Apple's at 240, and then they say you close out at intrinsic value. And if you don't know what intrinsic value is, you're not going to be able to offset and figure out where that's a profit or loss. I'll tell you, it's a profit. And you could have just memorized the break evens, 225 plus 9, 234, 246 points. Call up, put down. The other thing call up is great for is break evens and call contracts. Strike price plus premium. 225 plus 9, 234. By the way, same break even whether it's long or short. Put down. Great memory aid device. Good for, again, intrinsic value. If the market price is down, the contract has intrinsic value. We're looking at an Apple 230 put, and Apple's 228. Market price is down. The 230 put has 2 points of intrinsic value. Put down. Also good for break even. And put contracts, the break even is strike price less premium. So in terms of memory aid devices, that is one that I would certainly have in my hip pocket, right? And that would be something I'd be willing looking at. All right, what else can I think of in terms of just memory aids for options? I think a lot of people struggle because they think there's a gazillion things going on and there's not. There's only 2 types of contracts, calls and puts. You can either buy them or sell them. So there's only 4 things going on, but it's kind of like making a pizza, right? I saw where Domino's said they have 12 million different versions of a pizza. I don't really believe that. Well, but what they're saying is, you can put pepperoni, you can put cheese, you could do, and same thing with option strategies. And what I think sometimes people need to do is impose order on it. What I mean by imposing order on it, Bridget, is there are 9 option strategies you're held accountable for on your Series 7. Only 9. 6 of them are speculative, meaning you're just making a bet on the stock price. long call, short call, long put, short put, straddles and spreads.
Mm-hmm.
And then the other three are stock plus options, a covered call, a protective put, and then how do you change a short stock position from unlimited risk to limited risk? So those are the 9 that you're held accountable for. Now, in the actual exam, Series 7, you are going to get 20 option questions plus or minus 5.
Mm-hmm.
You could get 25, you could get 15. So, just got to kind of plot away. The other thing I would tell you is that option is the only thing that builds. What I mean by builds, if you don't understand a long call, there's no way you're going to understand a credit call spread.
Mm-hmm.
So, you got to be kind of a little careful. Everything else on Series 7, you don't get it, who cares? Because 10 minutes later, there's some different thing to get. And getting the new thing doesn't depend on getting the old thing. But, in options, you got to kind of lay that base and then start, climbing that mountain, so to speak. And what happens, the lights go on and they go out again. So you just got to work on making sure you're getting a long call and a short call, and you got to be kind of disciplined at where you're at in terms of laying base camp on that information. As I say in general, but particularly as it relates to options, inch by inch, options is a cinch. Yard by yard, options are what? Hard. Now, I'm going to put this up again in a couple of weeks, Bridget. I want you to come back to the live stream and I want you to have a particular option question, whether it's a covered call or a spread or a straddle or a QID from a Kaplan question. And I'm more than happy to put that up and work it for you. But
Okay.
you want to try and have a particular question, like, I always joke in class, if you ask me how does the world work, and then somebody asks me what the break even a covered call is, break even and covered call comes before how does the universe
Mm-hmm.
work.
Yeah.
So, we want to kind of narrow down that topic. All right, let's see. So who's next? Becca. Some 66 debrief questions. I'm not sure, Becca, what do you mean by that? Like, what did people encounter? Well, remember, every draw is a little different. I just had a guy today and he missed it by 1 point. Pretty typical. He said he didn't have to do any math. When people have to do math, it's like 3 or 4 questions. And boy, I don't know if you were on the live stream earlier, Becca, but Brian and I just, were you there?
Yes.
Yeah, we were talking about him and, I think a little bit of hubris. He missed the investment section. And I
He
think
had
it's
like
because,
one out of 7 or 8.
he missed it. And, people don't want to hear it, but I was trying to tell him, he wants to do more tutoring. And I said, well, listen, I want to tell you what I feel about you as your tutor. You don't really listen to me. I don't know why you're paying me if you don't want to listen to me. And in the sessions you purchased, I mean, I'm happy that you bought tutoring for me. I'm happy to do it. I said, but man, we were bouncing all over the place. I mean, you wanted to do this and you want to do that. And you said, we've done enough of that. Let's do this. I said, so, if we're going to book tutoring, I said, let me do you a service. I want to book a free Zoom with you a week out. I want you to refresh and reset. And in that free Zoom, you and I are going to decide what we're going to do in tutoring. And this time we're going to have an agenda, and we're not going to move on from one thing until we get that put to bed. And then we'll go on to the next thing. He's a very smart guy too. And sometimes this is I guess, a foible. I mean, I guess it's great. I mean, it has its downside. I think he's almost too smart. And what I mean by he's too smart is he doesn't take a strategic pause and read the full question, read the full answer. In his case, he missed it by 1 point. And then I told you, I asked him, Becca, did he change answers? And he said, yes, but he changed them from right to wrong. I'm like, or wrong to right. I'm like, eh. So every draw is a little different.
Investment vehicle in Kaplan Q Bank, which units should I focus on?
Oh, good question. So on 66, the two
Yes.
biggest sections are unethical business practices. Unethical business practices. NASA has a template called unethical business practices. That's 14 questions. And then disclosures. I think it's I want to say it's like unit 14, I think. And then the other one is disclosures. I think that's 12 or 13. That's 11 questions. So on the 66, that's 25 of the 100. Right. So that's, and what makes 65 and 66 challenging is there's not really a narrative thread. I mean, it's just all over the place. 2 questions here, 3 questions over there, another question over here. I think the 7 is actually easier in this regard. In the 7, there's a narrative thread. Right. What I mean is there's kind of a thread that takes you through the 7. Right. So we were talking to Bridget about options. That is a narrative kind of a thing that you start at this point and you end up at that point A to point B in terms of options. Whereas 65 NASA exams are just crazy. I mean, they're just crazy. Becca, if you send me an email, dean@guruexamprep.com, I do have a 66 debrief, remembering that every draw is different. I'm more than happy to forward that to you. So that, remember though, every draw, I warn this guy, right? Because now he's going to go back there again. And sometimes what people do is they focus on the draw they got, and then they, improve that, and then they go back down there and they get a different draw and they miss it again. So, all right, let's see. Max gain. Josh, is that options or what? Max gain, max loss on what?
Yes. So, you know how sometimes I'll ask you a question on what is the, for different things like the options, straddles, spreads. I was wondering, is there something that we could just like immediately, kind of like you say, rule out when it comes to
Yes,
max gain,
yes.
max loss,
We
and just
certainly
like any tips or tricks
we
that we can
certainly
like
can.
write down?
We certainly can. So if we have a buy or a buy, what I mean by a buy, we buy an option, or we buy the stock and we buy a put, or buy, we buy a call, we buy a put straddle. If it's a buy, it always has unlimited gain and limited loss, right? I take that back on the put, the buying the put, it would go to zero. But if you buy the stock, buy a put, unlimited gain. You buy a call, buy a put, unlimited gain. The other thing I would say, if it's a buy, it's always going to be the maximum loss is what you paid. So if you buy a call, you buy a put, you buy a straddle, you buy a spread, you buy the stock, whatever it is, that's going to be your loss. All right. So the flip side of that, because remember, there's always opposites. If it's a sell in terms of options, sell, 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 it always has unlimited loss potential, right? So if you sell a call and you sell a put, unlimited loss. You sell a call, unlimited loss, right? So in terms of sell or sell, advanced options, it's always going to be an unlimited loss potential. Flip side of that, if it's a sell or sell, that's always your maximum gain. The best case is you agree to be a potential victim. Nobody victimizes you, and you get to go neener. You get to keep the money. Now, there's a lot of words for that. As it relates to options, Josh, when I hear the word seller, short, rider, I always think potential victim, right? And nobody's going to agree to be a potential victim unless you give them some what? Money, right? And so, if it's a short call, I'm a potential victim because I got to deliver the stock at the strike price. If it's a short put, I'm a potential victim because I have to buy the stock at the strike price. So I don't know if that's helpful, but that would be what I would say. So, one thing you might want to do is just before you even jump into the question, is say, okay, is it a buy? Is it a sell? Just kind of get comfortable. I'm a big believer. The more time you spend on the setup and what I call RTFQ, reading the question, making sure that you, as much as possible, know what's being asked and what the answers being offered to you are. Again, tough love. I had a guy in a tutoring session, Josh, and it was a NASA exam. And I just was honest with him. I said, well, listen, you're not at the point where I think you're ready for tutoring. You haven't laid enough base knowledge to even know what's being asked and know what the questions are. He wants to queue up to the Q bank and start doing practice questions together. I mean, it's his money. And I'd say, well, I really kind of think this is a waste of time. We need to lay more base. Now, if you want to do that through tutoring, I'm more than happy, but that's a lot of money for me to walk you through this completely. I mean, it's your choice, but why don't we reconvene when you've had time to read the book, lay some more base, and come back to it? And I thought he responded well because we showed back up. He said, Dean, I'm halfway there. I go, what do you mean you're halfway there? He goes, well, I now know what I'm being asked. I'm still not clear what the answers are, but I at least now can read a question and kind of know what I'm being asked. I go, well, I'll take that. That is halfway there, right? So you got to get to where you can actually read the question and know what you're being asked. Josh, I think you're taking a 7. Is that what you're taking?
Yes, next week on the
I think
18th.
the 7 is easier again, Becca, in knowing what you're being asked and knowing what the answers are. again, I would just comment, I think the NASA exams are harder on that. I think one of the challenges in these NASA exams is figuring out what the hell you're being asked and then figuring out what is being answered. Now, I joke, depending on your test prep vendor, we talked about this in the live stream, whether it's Pass Perfect or Kaplan or STC. I always joke, good news, the test prep vendors are bigger jerks than the real jerks. So, they're trying to stretch your mind and hope it doesn't go back to the same spot. Now, sometimes I don't think that's what happens. Sometimes I think people just go, depending on what vendor you're using. All right, what's next here? So Philip's got another one. Let's see if I put away the Q bank. I hope I didn't put away the Q bank. Good
good.
news, I did not. Okay, what's the QID, Philip?
I'm good. I think that was the one
Oh,
I
the
had.
same one? Oh, okay. So let me get rid of the Q bank. All right, next 65 practice test. So I'm not sure, McMillan, that will come up. Let me see if it will or not. Sometimes they rotate the QIDs on a practice test. So this is 65.
I have a screenshot of it if you can't pull it up.
Yeah, okay. What's the QID? Let's see if it comes up.
158507-6.
5076. Let's see if it comes up. No, not found. So okay, so you can share your screen and we can take a look at it.
Let's see here.
Okay, Plifford
Yep.
standard stock. Common stock has an average return of 12%. It returns falls in with a range of 2 to 26%. So the range there is 28. Approximately 68% of the time. So it sounds like this is standard deviation. Standard deviation is, again, this idea of the variance in the data set. Which of the following numbers is closest to the standard deviation of the return of the standard Plymouth Standard stock? Do we have the answer key and rationale on this one? Is this a cute Kaplan question?
I did not have the rationale yet. I haven't finished the practice test.
Well, yeah, I would like to see the rationale. I would take the mid-range and go 2/3 from it. So mid-range, this is again what I call dead reckoning. I'm not actually doing the math, but mid-range of 28 would be what, 14? So
Yeah.
that would be 14. I would go for 14%.
Okay.
Like
So yeah, I'm meeting with you privately on Friday. So once I finish, I'll
there
note
you
it
go.
down.
There you go.
We can come back to it.
Absolutely.
Cool.
Absolutely. So I'll see you Friday. What time are we meeting?
Yeah. I think 10:15. I'll check, but
it's hot out here, Bill. My air conditioner can barely keep up. So I've been trying to book things in the morning when it's a little cooler because, well,
for sure.
Okay. All right.
Is
What's
that
next? So
Was that a 65 question, Dean?
what's that?
Is that a 65 question?
I
Yeah,
don't
it
think
is.
we'll practice test.
Okay.
I can't imagine any actual draw is 65 or 66 where I'm going to make you do standard deviation. But I am going to ask you to recognize it as variance. What I mean by that is I always use Philip MBA because I'm an MBA fan. And let's say that I'm a coach, Philip, and I've got two players. They both average 20 points and 10 rebounds. Their averages are the same. But one guy, Philip, gives me on a particular night, gives me 40 points and 20 rebounds, and then gives me nothing. The other guy on my bench, gives me 22, and then he gives me 18, then he gives me 8, and he gives me 12. And so while their averages are the same, this is neither good nor bad as a portfolio manager or as a manager of talent in this case, but which of my players has a higher standard deviation? Higher variance? It would be the player who is giving me 40 and 20 and then nothing. Now, that's not necessarily bad because maybe I need 40 points tonight and 20 rebounds. And I say, hey, get your butt in there, and the other guy's a reliable, consistent kind of person. It applies to investments, kind of the same thing, right? And what I mean by the kind of the same thing is if we have a higher standard deviation, we should be rewarded for that variance, that volatility, right? In other words, you shouldn't be doing that if you're not going to get compensated for it. Why take the risk and the volatility if you're not getting compensated for it, right? So it'd be a recognition question about volatility, standard deviation. And you just, Kaplan and Brian Deteski has a beautiful exhibit. And it has all kinds of information that has nothing to do with answering this question. And it just is about the standard deviation variance, and you would just have to pick the one that has the highest. So pretty straightforward as it relates to the test. BD and agent registration. So Chris, this is a pretty I think straightforward, maybe not. So here's how I think of it. No office, no retail, no register. No office, no retail, no register. Okay, now we got to flip it. Right? So the opposite would mean register. If I'm a B, by the way, it's the same rule for the agent as the BD because there's no such thing as an agent who's registered with a BD that isn't. Right? So if I have an office, a BD has an office estate, doesn't matter whether I have a retail customer. Doesn't matter. If a broker dealer has an office, they need to what? Register. No office, retail client. BD needs to register. Right? So
Dean, what I was confused about was like, I know they both register with both FINRA and the state. But what's confusing for me was when the agent like sets up a hotel meeting or something.
well, if you're soliciting in the state, so if you're an agent of a broker dealer, let's be clear, we're not talking about an investment advisor rep. We're talking about an agent of a broker dealer. And if I am soliciting in a state, I take a conference room. I'm coming to you from Nevada, and let's say I want to get some Mormon friends as clients. And so I'm going to start going into St. George, a beautiful place. I'm going to rent a conference room, and I'm going to start soliciting. Well, I'll take any Utahns. They don't have to be Mormons, but no Mormons. No. I think I like them. I get along with them.
No, I'm going. This is the University of Utah.
Oh, there you go. Okay, there you go.
I'm in Utah.
So to answer your question, Chris, if I'm soliciting in Utah, I need to be registered. So regardless, I don't think you'll see it on the test, but one that comes up is like it used to be there for years, and every once in a while somebody brings it up about I'm on a cruise ship in Florida, and I'm an agent, and I'm doing seminars on this cruise ship, and it's port is Florida. Chris, in that situation, I'm soliciting investors in Florida. I'm going to have to register, and then remember, the agent can't be registered. The broker dealer is not. So in this example, if I'm going to be soliciting in Utah, not only do I, as an agent of the broker dealer, have to be registered, but so does the broker dealer. So was that what you're kind of getting at?
Yeah, got it. I had another question related to
Sure.
the drawing that I won, but I can ask you that at the end if you'd like.
Okay. Well, no, I'm sorry. What the thing you won?
The drawing for the
Yeah. Did you win? Yeah. So you get the office hour, which is, I think, Thursday. Did you register for that?
What I wanted to know, is it possible to do that on a weekend?
Well, no, as I told you, it's not tutoring where you get to choose the time and choice, date of your choice. It's you join us in the office hour. But good news, there's more than one. I'd be willing to, if you want to, send me an email. And since it's you, for the next one, I'll put it wherever you want, and then people can join us. But it's not a floating thing. It's there. Is
Gotcha.
anybody joining me on the office hour already? I cap it. I'll let you in regardless of it. This is capped at 10, and for some reason, it'll let 11 people in. So I don't know. I'm not worried about it. I mean, more the merrier. But it's like our live stream. We had like 40 people. And if we were doing this in a whiteboard with 40 people, it would be a joke, right? So I capped this at 10, and I capped the office hours at 5. So just send me an email with what you would like for an office hour. Don't do it this weekend because I'm not going to do it. But if you put it out next weekend, when's your test date? Is it coming up or?
Test date is 22nd, and I have a live class next week, Monday through
Okay,
Friday.
so let's just send me an email, and I'll try and work with you on that.
Gotcha.
All right, let's see what else is next here. Micah has a 65 QID. Let's see if Dean can get smart enough to cut and paste this thing instead of asking you guys what it is. All right, let's go back to the Kaplan Q Bank. Where is my Kaplan Q Bank? Kaplan Q Bank. Damn, I guess I deleted the Kaplan Q Bank. Let's go back. Kaplan sign in. 65.
And I can read it off to you if you want.
Let me try it first. I'm trying to get better at being efficient. So if it doesn't work, I'll ask you to read it to me, but let's see if it'll cut and paste. Who knows? Knowing Kaplan, they probably have like a security feature that doesn't let people, cut and paste. All right, I got it. So let's now put it up there. A client owns an investment grade bond with a coupon of 7%. Is similarly rated bonds are being issued today with a coupon of 5. Wow. Mine pays 7. So I would imagine that my bond is now trading at a premium. If the market is efficient, so what that means is there's no arbitrage opportunity. That if I sell my bond today, it would be at a price that would give that person a yield to maturity of 5%. The point of yield to maturity, by the way, is to make fair comparisons between brand new bonds paying 5 and bonds in the secondary market paying 3 or 7. And that's why we price bonds based on their yield to maturity. So I say, Micah, your bond pays 7. Brand new bonds pay 5. If we sell your bond, you're going to get a premium. And if we sell it at a price that the new owner gets 5%, they would have a 0 net present value. The present value would be whatever they paid for the bond, right? So I'm not sure, you said you got positive net present value here? Did you remember what you answered?
Yeah, I did mark it as the net positive.
Yeah,
present.
no,
So I marked it
efficient,
as C.
efficient means that we wouldn't sell at a price that yields 4. We wouldn't sell it at a price that yields 6. We would sell it at the price that the market is doing right now. The market's 5. And so efficient means, again, this idea of efficiency means there isn't a big price discrepancy between the yield to maturity on the new bonds at 5 and the old bonds. If we bought, I just do the same question. Let's do the same question. A client owns an investment grade bond with a coupon of 3. If similarly rated bonds issued today pay 5, if the market's efficient, you would expect the client's bond, again, to be priced at a discount that would have a yield to maturity of 5. Right? Both the 3% and the 7% bond would be priced to have an internal rate of return yield to maturity of 5%. So this is a tough one, certainly. This is a tough one. So, yeah, I'm sorry.
Oh, I'm sorry. I was gonna say, I think I get it, but it's possible you could do a quick example where it would either have a negative or
Sure.
positive.
Yeah, no, I can do that. Do. I thought you were taking a 7, Josh.
Oh, I am, but I failed my 65, so
Okay.
yeah.
Let's do it.
I was gonna say, whoop, wrong deck.
And you've also mentioned too that if it's, I want to say if it's at a discount, then it's the yield to maturity. And if it's at a premium, then it's the yield to.
Well, that's on the 7. That's for our friend Josh. So, when you're quoting bonds, you quote them either on a yield to maturity, yield to call basis, because that's what people do when they buy bonds. They either hold them to maturity or they hold them to the call, right? So that's a different issue. That's not an issue on the 65 or the 66. It is an issue on other exams. All right, so here we go.
That's wonderful to hear.
Let me,
Sorry for you sevens.
boom, 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 boom. Boom, boom, boom. I just trying to find, I have an example here and I'm just looking for it. Where is it? Here it is. All right, let me go find you guys. Okay. Can you see my screen?
Yes, we can.
All right, so a bondholder paid $925 for a corporate bond paying 6.5%, maturing in exactly 10 years. Was the bond priced fairly? So, Micah, this is very much like your previous Kaplan practice question. Fairly means efficiently. So we would expect this to be priced at something that would approximate new bonds on a yield to maturity basis. And so what I'm trying to figure out here is what is the present value of 20 payments of 3250. So how does Dean come up with 20 payments? Well, bonds pay semi-annually. 10 years means there's going to be 20 payments. It's $65 a year. And so there's going to be 20 payments of 3250. And the last payment of 3250 isn't worth as much as the next payment of 3250. A very important concept in time value of money, that money today is always worth more than money at some future date. I also want to figure out what is the present value. Hold on. Yeah, Mom, what's up?
You want anything?
I think I'm okay. Bye. When we're back in Vegas from the off-grid, Mom likes to go see all her senior friends and before we go back out to the middle of nowhere. She wants to move to the off-grid location. I said, Mom, here, if you have a medical problem like 3 weeks ago and I call 911, within minutes, the fire department shows up, there's ambulances. And if we move to my off-grid location, it'll literally be 4 hours before anybody can come to rescue you. So she's on her best behavior when we're out there because I tell her, man, if she falls or slips, we're never moving out there. So the other thing I want to figure out is what is the present value of the $1,000 I'm getting at maturity, right? So I'm paying $925, and for that $925, I'm getting 20 payments of $3,250, and at maturity, I'm getting $1,000. Now, again, as we've said, you're not going to have to do this math. Where we're heading here is, I think the question was, can I show you an example of net present value? And that's what we're doing. We're working our way towards the net present value. But to figure out net present value, we first have to know what present value is, right? Because again, what we're trying to figure out is where we got a good deal or not. So if we did the math on the present value calculation, given information, we have discovered that the present value of 20 payments of $3,250 is $371.94. That's what those 20 payments of $3,250 are. You can't actually do the math on the test because you would need an exponential key that you don't get. I mean, the calculator you get is this thing, right? So it's not going to be able to do this. And then the present value of that $1,000 10 years from today is $553.25. So the present value is $925.62. We paid $925. So was that a good value? I think so. And your point, Micah, it looks like the market is pretty efficient. It's pretty efficient because there's not a big difference between what we paid, $925, and the present value of $925.62. So it looks like this market is pretty efficient. But let's say we didn't buy the bond yet. We haven't bought this bond, but we have established that the present value of this bond is $925.62. Right? And now we're sort of deciding whether we should buy the bond or not, or whether it's a fair value. So if we could buy the bond for $921.25 and the present value is $925.62, it looks like a good deal, right? Because we have positive net present value. It's not so much can you do this math, it's do you understand or recognize this is a good value. It's a good value because we're being able to buy $925.62 today for $921.25. That's a good value. So if we can get it for less than the present value, we have positive net present value. Okay, let's say we're considering buying the bond. We know present value, and the cost of this bond is $928.75. Would we want to pay $928.75 for a bond that's present value is $925.62? The answer is no, because it has negative net present value. right? And so that's what that present value is about. And basically what you got to tell me is that you understand that a positive net present value is a good value and a negative net present value is not a good value, right? We might say on the test that it's undervalued if there's a positive net present value, and it's overvalued if it has a negative net present value. As applied to stock, I think somebody asked that in the live stream tonight. So this is called discounted cash flow. As we apply that to a stock, it's called the dividend discount model, right? And then in the dividend discount model, we can assume the dividends grow or do not grow. That's called the dividend growth model. All right, so that was an example of net present value. Let's see, what's next? Convertible bond, Christina. I'm having a hard time finding if the client should sell the bond or convert to the stock, hold to maturity, or redeem at the call price. Well, to do that, you have to do parity, and it looks like you have a question, so let's go find the question. Boom. Series 7. Let me go find you guys again. There you are. Okay.
Dean, did you say undervalued negative NPV? Is that what you said?
No, I said positive net present value is undervalued, negative net present value is overvalued.
Thank you.
Yeah, remember you're looking for the deal. The deal is to be able to pay a lower price today. You know, I'm not a regulator, thank God, but I mean, you know, when I watch these commercials about JD Wentworth, I don't know, maybe you guys never seen these, like, call JD Wentworth if you need your money today. And the reason I don't like those commercials is because I think they're taking advantage, Josh, of math, right? What they're doing at JD Wentworth is saying, Josh, how many payments are you getting from that settlement? You say, oh, I get 1,000 a month for the rest of my life. And then what they're doing is doing a present value calculation, right? The present value of your future payments. And then what do you think the number they're going to give you is? More than the present value or less than the present value? Yeah, they're going to give you less, right? And they're going to have positive net present value on the difference between what they gave this person and what that is worth, right? So, you know, I'm more of a libertarian than I'm sounding right now, but, you know, caveat on emptor, but, you know, that is a math question, right? It's a math question, right? And so maybe, listen, I shouldn't beat up on them. All I know, maybe there's a 20-page disclosure they send to you before you sign away your payments and show you the math and say, you know, and I'm sure the people who want the money now are going to say, why are you playing God with my payments? You know, if I want the money now, I want the money now, you know, but that's what that's about. Okay, so this one was, let me see my Kaplan Q Bank. Here it is. Let me find you guys. Boom. And you guys see the Kaplan Q Bank?
Yes.
Okay, so Reggie owns a convertible bond that's convertible into 20 shares of common stock. First thing I think, Christina, is, hey, they gave me the conversion ratio. Thank you so much. Sometimes we have to figure that out. You know, they give us the conversion price. The current market value of the bond was, oh, Kaplan being jerks. Customers get hung up on this all the time. That's yesterday's news. It's not trading a 118.5 today. That's what it was trading on Friday. I can't tell you how many times I've had to tell the customer, Mr. Jones, today's Wall Street Journal is yesterday's news. That's what happened yesterday. That's not what's happening today. On April 1st, a 30-day call was announced before the opening on Monday. So that's important because the market price is no longer in play, right? Because now the entire marketplace knows the bond is being called. And they know the bond's being called at 102. And so nobody's going to pay 118.5 for a bond that's going to get called at 102.5, right? It's going to be something close to that when it opens up. So it says it's a call price is 102. So the choices are, do we want 1,020 or do we want 20 shares of the stock? So here, what we got to do is figure out what is the most money. And so what we're going to do is we're going to figure out parity. And I say, Christina, if we turn this bond into the stock, we would get 20 shares of stock that is worth 57.55. 57.75. I'm gonna get out my calculator. 20 times 57.75. That is 11.55, right? 20 shares times 57.75. That's $1,155 worth of stock. So the question is, do you want 1,020 or do you want $1,155 worth of stock? And I'm saying, Christina, I think we should get the stock because 20 shares of the stock is worth 1,155. By the way, if we did the math and the stock was 50, I'd say, well, Christina, 20 shares of a $50 stock is 1,000, and 1,020 is better. So all we're going to do to answer your original question is we're going to compare the price, the call price, to what the stock is worth. Right? And how am I getting the stock? By the way, what I just did here is called parity of the bond. The bond is worth at $1,155 worth of stock. And that is worth more than the what? That is worth more than that. Right?
I
So,
was confused because the bond traded at 118.5 on Friday.
yeah, remember the key
All
word.
at 102.
Yeah, that's the key word, right?
Okay.
It was. So,
Right.
so Calvin being jerks, that's yesterday's news, right? So right now it's not going to be a 118 because this is going to go down to whatever that call price is, right? All right, good. That's a tough one. Those are tough ones. But the key point that you're all going to have to do is parity on the 7. In other words, you have to answer this question, you got to be able to do parity. Parity means equal. So 20 shares of the stock is the equal of the bond being worth 1,155. So that's called parity of the bond or parity of the stock. Right. And then let's see, that's what Kaplan did there, right? It looks like the rationale is looks like they did it kind of the way I did it there. Okay, so let's see what's next. We're running a little over here, but that's okay. Why wasn't 1 included in the answer? Because in a state.
Sorry. Go ahead and pull up the QID.
I'll get it.
What
Chris,
the-
I'm not sure who hosts the live class. It's me. Is that what you're asking, Chris? The live classes are on the booking page. It's Dean, it's me. And the live classes are always $35, $40. I'm not really interested in making money off the class. I like to record it and then I put it as a replay on the channel. So the YouTube is the bigger deal to me. It's not really, like this. Again, it's being recorded. I'll probably splice it. The good stuff I splice. If it's bad, I don't like it. I go, ugh. But I like our net present value. I might cut that out of there and maybe put that up on the channel, right? Net present value. Let's see. So I'm not sure, Chris, that question, but it's me. All the classes, it's always me. I take that back. Every once in a while, I talk Brian into teaching the class with me, but he's not into it as much as I am because he's into getting paid. Not a bad way. Not a bad way. All right, so let's see another 65 question. Let's see if I got my Kaplan Q Bank up. I do. Okay, 65. Boom, boom, boom. Okay, could you read me the QID?
Yeah, 157
157
8028.
8028. Under the Uniform Securities Act, which of the following are true regarding
You need to
private?
share your screen.
What's that?
Were you going to share your
Oh,
screen?
my bad. Let me go find you guys. Can you guys see my screen?
Yep.
Under the Uniform Securities Act, which of the following statements are true regarding private placements? Your question is, why is number 1 not part of the answer? They may be offered to no more than 10 persons in a state in a 12-month period. Well, remember, it's non-institutional persons are retail clients. I'm not sure it makes the distinction here, but remember, there's two types of persons on the test. There are natural persons, living, breathing human beings walking planet Earth, and there are unnatural persons, not living, breathing human beings walking planet Earth. Institutional investors are not natural persons. So I'm thinking the reason one isn't there is because they didn't make the distinction in the question what kind of persons they are. Are they natural persons or institutional? I agree that's kind of a splitting hairs a little bit. Let's see what our Kaplan rationale says. With the exception mentioned shortly, private placements are transactions resulting from offers to no more than 10 non-institutional retail clients. I think Joe's six packs in a 12-month period. The offer must be convinced that retail clients are purchasing for investment purposes. This means no immediate resale intentions are allowed on the buyer's part. No commissions may be paid directly or indirectly. The exception is that sales to institutionals are exempt, there we go, to the limitations. They may therefore be offered to more than 10 persons. So I agree with you, that's a tough one. It looks like the distinction Kaplan is making is that we didn't explicitly tell you what kind of persons those are. And are we clear? It has to be, it's a retail person. So tough. That is tough. I wouldn't beat yourself up on that one. Starting the SIMs, Elvis, for Series 7, aside from options, munis, mutual funds, add Elvis mutual funds to that. So you're going to get 20 on options, give or take, 20 on munis. I highly recommend, Elvis, taking a sheet of paper while you're studying and folding it in half. And on one side, write all the terms associated with geo bonds. And on the other, all the terms associated with revenue bonds, because that is a big part of your exam, is distinguishing between geos and revenues. They just love like questions like all the following are associated with revenue bonds except, or all the following are associated with geo bonds except, right? And we'd have on the geo side, we would have overlapping debt. We would have taxes. We would have ad valorem. We would have assessed valuation. We would have voter approval. On the revenue side, we would have user fees, feasibility studies, flow of funds, net revenue or gross revenue. So that's what I would recommend there. Let's see. Then we got another 65 question.
Thanks, Dean. I appreciate it.
You bet. You bet. Let me get 65. What's this one? What's the QID on that one, Micah?
152
152
4548.
48. Yeah, let me go find you guys. Mary Huggins is the ex-wife of Charlie Huggins. They were married for 12 years and then finalized a divorce. Charlie is now 70 and he's begun taking his Social Security's benefits. Mary remarried last year. It would be correct to say that Mary is not entitled to Charlie's Social Security benefit. I'm not sure. I don't think you'll ever see anything like this on your test, but what did you find problematic about this one?
So I thought that she could choose between, and maybe it's if the first husband died, maybe I was getting it confused with if she could choose which Social Security she drew, but maybe because she was divorced, it was that
The only test question about divorce isn't this one. The thing that you get tested on both 65 and 66, I can't imagine any drawing which you don't get tested on is a quadro, right? The qualified domestic relation orders. I don't think you'll see anything like this on your test. I haven't had anybody on debrief tell me they've got questions on Social Security.
Okay.
Do you have a video on bond groups? I'm not sure what you mean by bond groups. What do you mean by bond groups?
Well, I've had a couple of questions on 2 different attempts on my 65. So not on a test.
Yeah. So but what is a bond group? I don't even know what you mean by a bond group.
Well, I wrote down bond group after I walked out of the exam thinking, I don't know what I'm even looking at on this.
Well, the only thing I'll take a stab at it. I mean, I am going to give you maybe in the answer set is a group of bonds. a group of bonds, like choice A is a bond, B is a different bond, C is a different bond. They're all different. And then I might ask you, this is very testable, which of the bonds is the most volatile? Which of the bonds has the highest or longest duration? That's the fancy word for volatility. So if we're looking at a group of bonds and we're asked what is the most volatile bonds, on 7, they'll ask the same question. They just don't use the term duration. And the way we answer questions about volatility on a group of bonds is long and low. Long and low, baby. We always go long and low. The longest maturity and the lowest coupon in a group of bonds is going to be the bond in that group that is the most volatile, changes the most often. And I would just say, be careful, because they might throw you a change up and say least volatile, then it would be the opposite, right? It'd be the shorter term bond, right? So you go with a longer term bond first, and then you do that. Let me just show you, I'll show you one more, and then we'll call it a night. Boom, boom. I'll take care of that, Christina. But let me show you another one here. Shared screen, and let me go back.
What about zeros, Dean? Are they volatile?
Oh, absolutely. And the answer is set, right? Long and low. So zero coupon bond has no coupon. So that's certainly going to be the most volatile. Okay, let me go get another one here. Boom. Now let me find you guys. Are you guys still there? Did I lose you guys? What happened to you guys? There you are. Okay, can you see my screen?
Yes, sir.
About find my. There we go. All right, so duration is this idea of volatility, right? So here's 2 bonds, and I ask you which of these bonds is the most volatile. So remember what we said? Long and low. So we first go to the longest maturity, in this case, 2052. And we would say lowest coupon, tie on the coupon. So the answer to this question is that this is going to be the most volatile bond. And the way we say that in fancy language is it has longer duration. Right. So you shop the answer set, you take the longest term with the lowest coupon. Here's another example, right? So here's 2 bonds. We go long and low, baby, long and low. So we go long, they both mature in 2042. So what's our next decision factor? The coupon, right? So that is the bond that's going to be the most volatile. Is going to have, again, the highest duration, right? So that's the fancy word in a group of bonds. Now, I showed you 2, but on the test, there'd be more than 2. Christina, Series 7, fundamental analysis, technical. Technical is neither one of them are a big deal, Christina. What I mean by that is, I know we're going to our 4th year on the channel. I didn't have anything on technical analysis for like 2.5, 3 years. And I didn't have anything on balance sheets for 2.5 and 3 years because I just don't really think it's important. But I do have a class replay, Christina, you can watch on fundamental analysis. It's a class we did 2-3 weeks ago. And you can certainly watch that. We go through a balance sheet together, and that's available on the channel. And with fundamental analysis, right, you're either doing top down or bottom up. What I mean by that is you're either making a decision about the economy, then an industry, and then you're doing fundamental analysis on the stock. Or you're going to do the stock, the industry, and the economy. That's called bottom up. So in fundamental analysis, we're trying to use fundamental analysis to get a margin of safety. You know, for example, I'd like to buy the stock at close to book value as possible. You know, this is like a value kind of a proposition. You know, guys who are investing for growth or tech don't do fundamental analysis so much. But technical, again, a couple things on technical. You should know charting patterns. You should know support and resistance. Support's the bottom line. Resistance is the top line. You should, Christina, know a head and shoulders pattern, which is a signal of a reversal. You can put technical analysis into the channel search bar, and what will come up is lots of stuff on head and shoulders patterns, support and resistance, all that kind of stuff, right? So those are the patterns you should know. Again, technical analysis is not as important as fundamental analysis. And then the other thing is when you go on to your 65 or 66, Christina, in that exam, you should know that technical analysis under the weak form of the efficient market hypothesis doesn't work. In other words, that somebody who believes in an efficient market would not believe in the practice of technical analysis, because what you're doing is using charts, past price performance, to predict future. I just put up a video on overbought and oversold, which are technical terms. I guess people don't watch the videos sometimes because the guy in the comment section said, "Is this on the test?" I started the video by saying, well, I don't think you're going to see this on the test. It's more of a test prep vendor question. I don't want to be rude, but I want to say, well, did you even hit play? Because it starts by telling you, don't worry about it. So I think test prep vendors in general, Christina, make a bigger deal about technical analysis than do other that's on the test. Like, I Past Perfect goes into head and shoulders and, or excuse me, saucers and candlesticks and, so. By the way, it makes sense, by the way, in both of them, because remember the Series 7, we have a research department. You're not doing this. As a broker, I'm an intermediary. It's not my job to do this stuff. It's my job to be able to present it to the client. And therefore, I have to have a general understanding, right? It's the analyst who actually comes up with this stuff, right? Let's see. If scoring below 75 within 10 days no, I don't think you should push it out, but I want you to be comfortable. As I recall, is this your third time?
Yeah, this is my
That
third
makes a
time.
big difference, because if it's a third time on these exams you miss, and you got a 6-month wait.
Yeah.
So I like a 75. I like it. I would encourage you to go. But anything we can do in those last 10 days to close strong, I would be a big believer in it. Right? If we could push that to like higher 70s, we're not going to go from 75 to 85, but if we can do another practice test or two, and we can 76, 78, 79. The higher we can get, the more margin of safety we have. And that's all good, right? We don't want to be hovering around passing. That's not the place to be spending time, right? I told you this guy who missed it by a point. That's why I believe in overlearning. So you can take down any kind of a draw, right? Even if you get a face of death draw, you can take it down. So I understand that third time is real kind of mark. But I would still encourage you with those scores to go for it. Particularly, you still have 10 days. So if you don't get wobbly, you just got to finish strong. So every once in a while, people, they think they're studying and they're spending 3 hour, 3-hour study session, and they're spending 2 hours thinking about failing and 1 hour actually, doing the work. So as much as possible, try and stay focused on doing the work. Right. And even though that's out there, that's what I would tell you. All right. Well, we ran a little over on that, but that's okay. I put these up about every other week. So be looking for another one. Tuesday after next. That's kind of the pace I'm trying to keep. I don't want to commit to a pace that I can't keep. And then remember, on the booking page where you book this, you can find the classes that I'm offering. And if you want another class, just tell me, and I'm more than happy to put it up there on whatever. But I think we have mutual funds. We have economics. Economics is big on both the SIE and 65. I have a mutual fund coming. I got the basics options on Thursday. I'm just finishing up an SIE 3-day class, and I'm trying to pace the evening classes that will kind of be around when I'm teaching a full class. So Series 7, I'm teaching a Series 7 next month. So I'll have a more, sub 7 stuff, maybe advanced option strategies and that kind of stuff. All right. You're welcome, Elvis. I'll see everybody next time.
I just sent you an email with my stuff.
Okay, there you go. Perfect. I'm
Thank you.
not going to check it tonight. I'll check it in the morning.
Thank you.
Okay. Bye-bye.